Ladies and gentlemen, yesterday I told you to tell your fellow bears to follow me as therapy for everything they've been put through this year, and I was inundated by a ton of bears asking me what to do next. So here is the game plan. Number 1, the divorce papers your wife just handed you. Sign those, cut the dead weight. Number 2, subscribe and turn on the notification bell. Number 3, buy ticker symbol SPY and IBIT and wait. It's that simple. No need to overcomplicate anything or do mental gymnastics to rationalize this market. Nothing is rational anymore. Also, the big beautiful bill is codified into law. 6% deficits will keep this gravy train going, so let's talk about it. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks posted fresh record highs on Thursday as investors digested a stronger than expected June jobs report that dampened hopes for a Federal Reserve interest rate cut soon. And as a result of that, it was very green. The only real red we saw was like rate sensitive sectors, for example, home builders on the back of rates just rising. A couple of places in the energy sector because, they are rate sensitive. Real estate, a couple of names were kind of red. And then we just had some of the defensive names, for example, consumer defensives, a little bit in the red. Other than that, it was green through and through, led by the mega caps. Look at technology, semiconductors, software, Apple, Amazon up 1.5%, Microsoft, infrastructure as a whole, tech very red. Look at Google and Meta, services as well. They participated. The entire sector, financials, very green. Everything from Visa and MasterCard to Bank of America to Berkshire to Morgan Stanley to Progressive. Everything was red, and even healthcare, not the best performing sector today, but very green through and through. And when you get this type of participation, you're going to get a day that's very red. And today was a shortened trading day as well. We closed halfway through the day with the S&P 500 up 0.79%. And to be honest, the relative volume was actually pretty strong today, despite the shortened trading day. Only 2 sectors were in the red. That was XLP and XLB. And even then, they were just up, down 0.05 and 0.07, and clearly a risk on day because gold was down 0.68%. It was just a rotation from defensives, from gold, from safe havens into risk assets, into equities, particularly into technology, financials, and industrials. The S&P 500 doing very well, but it wasn't just large caps. It was small caps. It was mid caps through and through. Large caps obviously took the icing on the cake. Large cap growth up 1.3%. Large cap core up 1.89%. But it really was just a day for growth. Mid cap growth, small cap growth, large cap growth, all posting returns in excess of 1%. But value core, mid, smalls, even large caps, still putting in the work, green in all of those sectors. It was a mixed day globally. However, look, Europe was green, but Asia was very red. China, India, Southeast Asia, as well as Australia and New Zealand. Just this side, sort of the east of the world, that side of the world, really red. But when you look at Canada, America, South America, North America, the Middle East, even South Africa, these names were very green on the back of what was just positive developments before, leading up, and after market open and close. And it all kicked off with Donald Trump lifting chip design export curbs as a part of his new China deal. This is how Donald Trump likes to do business. He likes to have a little bit of leverage. So these aren't Nvidia chips. This is stuff like Synopsys and Cadence design systems. He lifted their exports. Their designs can get exported to China. Barclays came out and predicted this could boost revenues by 12%. This entire sector was up as a result. Now, it's not AMD. It's not Nvidia. It's chip designers, right? Stuff like Cadence design systems. But this was overall positive for the market. And it maybe could be a read-through as to maybe easing chip curbs for stuff like Nvidia and AMD. We also got some trade policy news. The EU Commissioner von der Leyen came out and said, we are ready for a deal, aiming at an agreement in principle with the US on tariffs. So I think we might get that this weekend, maybe early next week. And I think we also might get the full China deal, the full India deal, and a full Japan deal. All of these trade deals are going to start coming through, and that's just going to be upside for the market. But I think ultimately what really did move the market today was actually the big and beautiful bill. This officially got voted into law, 217 versus 214 for yes. This big, beautiful bill is going to widen the deficit. It's going to keep it at about 6 to 7% deficit. Again, not good fiscally, but great for the markets. This is going to be stimulative for the economy, providing tax cuts, deregulation, increased deficit spending, work requirements for Medicaid. It's a very stimulative bill for the economy. And when you run 6 to 7% deficits, that's 6 to 7% unfunded money creation. That is going to go directly into risk assets, housing, gold, Bitcoin. So you guys want to be long risk assets because we've got a strong runway for the next 3 to 4 years for Trump to execute on his agenda. And then also what really moved the market, probably what moved it the most, had to do with the non-farms data. Non-farm payrolls came out. We were expecting 110,000. We smashed expectations at 147,000. The unemployment rate fell from 4.2% to 4.1%. The consensus was for it to rise to 4.3%. Average hourly earnings came in a little bit soft, and that could actually temper inflation expectations with regards to this number. We were expecting 0.3, and then year over year was 3.7 versus the 3.9 expectation. And then initial jobless claims also came in lower than expected. All of this data is telling us that the labor market continues to remain resilient, and the ADP number was just an outlier because that is a business losing market share to its incumbents, to its competition. So maybe we should start taking that with a grain of salt. But the labor market looking really, really strong. And as a result, stocks rallied, Nvidia ripped, obviously on the back of all of the positive momentum, but as well as the chip curbs. And Nvidia at $160 per share, which he touched at the high right here, is a $4 trillion company, the first company to ever do that. Absolutely insane. Now, CoreWeave was up 8.85%, and it's the first cloud provider to deploy Nvidia's latest AI chips, not the Blackwell, but the Blackwell Ultra. And so you're going to see a lot of new deals in this earnings season. I think CoreWeave is going to go to $200 per share. I really, really do like this name. I think it's overvalued, but if you're looking for a name similar, you could look at NBIS. Very, very similar to CoreWeave. Nvidia also backed, and I think NBIS is going to be the next in line to implement, these Blackwell Ultra chips. Datadog today was up 14% after it was announced it will be included into the S&P 500, and everybody was expecting Robinhood to be included, and so the stock was down 3.89%, but it had also gone on a spectacular run-up, reaching highs of $100, and this was a $28 stock just 3 months ago. And then for everything we saw today, there was 1,990 decliners, 4,100 advances. Amazing breadth, guys. Now, we did see inflows in both the Nasdaq and the New York Stock Exchange, but intraday, we did see outflows here from the Nasdaq, just ever so slightly, with the S&P 500 up 0.83%, another new all-time high, and market momentum remains solid. Again, everything from the 5-day to the 200-day above the 50% mark. We saw tangible improvements for last week. This is exactly how you want to end the week, with strong market breadth, strong market momentum at all-time highs on the daily and weekly. Let's hop on the charts and talk about it, because today was a spectacular day. Now, guys, quickly looking at the charts, you can see today was a very green day through and through. Large caps gained, small caps gained, the equal weighted S&P 500 gained, mid caps and small caps gained as well, but really a day for the large caps, with the Nasdaq 100 finishing just shy of 1%, the S&P 500 up 0.83%. Definitely a day for growth. Value outperformed as well. Look, growth up 1%, value up 0.5 percentage point. Volatility was very mixed. Spot VIX fell. Front month VIX actually gained ever so slightly. And as a result of the strong economic data, yields rose in a very, very significant way. We were seeing them go lower on the back of weaker than expected economic data in the last couple of weeks. So we probably are going to have a little bit of a rally year in yields. The dollar was up for the exact same reason, and then TLT bonds was down. When yields rise, bonds have an inverse relationship, and you're going to get that type of return. Bitcoin was up 0.84%. Ethereum roughly the same. A solid day for crypto. And then gold, we actually just opened the new contract day, but gold was down, silver was down, and WTI was down. Now, guys, if I bring your attention to the S&P 500 right here, I've kind of iterated a version where we can see M2 money supply against the S&P 500. And guys, similar to what we're seeing with Bitcoin, you can see that the S&P 500 tracks M2 money supply, although the correlation is off at about 35% of the time, and it really does overshoot. Nonetheless, when we actually look at the path, right, we can see that the S&P 500 does have a long way to go, and we're looking potentially at a 6,800 target by the end of the year. Now, looking at our S&P 500 gamma model, you can see that, guys, we are at the top end of the range. That's what we were expected. We did see the core wall and the gamma flip move up ever so slightly. It has been an absolutely crazy rally here from the 5950 area to where we are right now, the 6200 area. And I do think we are going to go higher. The path of least resistance is higher. I thought we were going to see a little bit of selling to end the week, but the data was just too strong. Non-farms smashed expectations, and as a result, we gapped up, had to go. This is a very bullish candle, and we officially are done for the week. And you could see this is a very, very bullish looking setup right here, guys. When you have that strong candle and another bullish candle on top of that, it probably means more upside. Any dips are going to be bought. Any dips are going to be shallow. Earnings per share has moved up to $300 for the S&P 500. And we probably will even go higher as the year goes on. And that probably means more upside for the S&P 500. And when you look at the weekly chart on a technical basis, right, you could see that in 2022, we sort of put in this low right here. And we've just made higher lows all the way up. Now, we did put in the Liberation Day low. We did make a lower low as a result. But the dip was bought. There was a ton of fear right here. And this was a higher low relative to some of these other lows. And then we made our way to all-time highs. At the same time, we kept putting up highs, 52-week highs, and all-time high. And now we've closed another week, the second week in a row at all-time highs. And that's an all-time daily close high as well. So very solid momentum. You don't want to fight this trend. Again, in the month of July, pullbacks are going to be short, sweet, shallow. We can talk about a little bit of turbulence later on, but guys, ultimately any dips we do get, we want to buy those dips because seasonals are on our side. And there's just a ton of good news. The economic data is coming out and we just got rate cuts on the table. And that is why we're seeing just equities, risk assets outperform. We're also seeing stuff like the IWM and small caps outperform. When we go ahead and look at the RTY, you're actually seeing massive outperformance here. And when we actually look at the core wall, the RTY core wall moved up in a significant way, which means 2300 is on the table for the RTY. If we go on the daily chart, you could see that we've had a very, very strong move off the lows, and there's some like tangible upside to the top end of the core wall. So where the place you want to be next week, it's probably the Russell 2000. I think if we do get a dip here to the gamma flip, buy that because we probably will go ahead and touch the core wall by the end of the week, guys. Equities look very, very bullish on the weekly chart, on the daily chart. That means shallow dips, shallow pullbacks. Buy those. We're going to go upward. I think stocks, US stocks are just working right now, and you don't really want to fight that trend. When you look at European stocks, they're also kind of working, but basing out at the moment. They couldn't retake those highs, those all-time highs when we're making all-time highs in the S&P 500. Nonetheless, we did say that this was a great opportunity to go ahead and buy European equities right here, because I do think they're going to outperform. But if you're looking for European equity names, I think stuff like NBIS is better risk to reward for a name like this. I'm looking at EVVTY, good risk to reward in a name like this, strong momentum. And also Novo Nordisk, but maybe keep this position small. I think Novo could also outperform. So those are European stocks I would look at if you don't want to go ahead and just buy the stocks 600 index. Middle East Israeli ETF. It's probably the only ETF I'd buy in the Middle East. Still waiting for a pullback to 47. Doubt we're going to get it. Absolutely banging off these lows right here. I mean, when you take a move, it's up 38% off those Liberation Day lows. And then China stocks, yeah, you know, I mean, if you want to be a buyer at the 33 level where we are right now, I wouldn't be surprised. We'd probably go ahead, take over the 35 and potentially retest the 38 mark before the end of the year. Now, guys, let's actually talk about Bitcoin. You can see we are approaching this equal high right here. All we need is a solid couple of days next week, go ahead, break above this high, retake all-time highs, and went on to the races. You could see we were forming like a wedge right here, but we've broken above. And while we did put in like a consolidation period, a low, lower low, we then actually made a lower high, but we're now putting in a higher low relative to this. That's constructive. If we go ahead, retake this high, we can then aim for the all-time highs. M2 money supply is telling us that there's definitely more upside for Bitcoin and equity markets as a whole. We are going to continue to push to this 135,000 area right here. This was a great consolidation period, great entry. I added some Bitcoin. I added some options as well. Very, very solid. And guys, this is all-time highs for Bitcoin. There's nothing more bullish than all-time highs. Let's quickly go ahead and look at gold. Gold hasn't performing too well, and I think risk assets are going to continue to outperform against safe havens. Like I said with gold, look, we're going to be forming a consolidation zone in this area, and then we'll make a break to the upside or the downside. I do think there's some upside for gold, especially with how much money is going to be coming into the system over the next 2 to 3 years. I think we probably see like 5,000 gold, but we do just have to digest this massive, massive move off the lows where gold has been outperforming just even risk assets, equities, the S&P 500 over the last 12 to 18 months. So yes, I'm bullish gold. Maybe if you can get it at this low end here, 3,200, 3,100, I'd be a buyer. I think we're going to see more upside for gold over the next 12 to 18 months. Guys, I'm diving into sentiment. This is the AA sentiment survey, and the bulls are back. 45% here for bullish sentiment, bearish sentiment at 33%. I wouldn't call it elevated, definitely not low. It's at about the historical average. So there still is skepticism in this market, but the bulls really taking a massive step up. It's very clear to see that a lot of the bears on the sidelines picked a side. They either jumped into the bullish camp or they turned neutral. And those that were neutral got incrementally more bullish, especially when you look at how the survey is structured. It's on a week-to-week basis. And, in the last week, markets have been pretty bullish. The S&P 500 up about 3.5%. That is going to change sentiment, especially when you hit all-time highs. We are in the month of June, so expect more of the same. And it's absolutely crazy to think about the fact that at one point during this year, we were down 19% at the lows, nearly a bear market. We are up 5% year to date. And this really goes to show the resiliency in this market, because if you look at other times where we had a 20% pullback, we finished about 6% for the year. So to actually see this number this quick, it really goes to show two things. Number one, just how resilient this market is. And number two, just how much of a non-event tariffs were. And it didn't really have an impact to earnings. And that is why we're doing what we're doing now. And to be honest, I see further upside. And if it wasn't for tariffs, man, the S&P 500 might be at 6,500 this year. But look, this is the story about the market right now. It has to do with earnings. 2025 earnings is still looking for about $264 in earnings per share. That's about 9% growth. And then even looking ahead to 2026, estimates are officially for $300. They were like $285, I swear, 2 weeks ago. And then for 2027, we're looking at 337. And again, that's 14% growth and 12% growth on top of 9% this year. Yes, that has been revised down significantly. Don't get me wrong. We were looking at about 13% growth to start the year off, but net, that's very, very solid, the earnings figure. And we were expecting double-digit growth in 26, 27, and that is why the market is rallying, and the macro is somewhat supporting that. I mean, the labor market is definitely showing us signs of deterioration. US private payrolls fall for the first time in 2 years. This was the ADP data we got yesterday. It came in at a negative 33,000 number. Not good at all. But in yesterday's video, I sort of talk about why that is the case with ADP losing market share. When we look at my favorite employment figure out of all of them, right? I think the federal employment tax receipts is number one. It's a real-time, week-to-week gauge as to what we do. And we're sitting at about 5.9% growth here up until the 27th of June. So this data a little bit dated for the month of June, looking at about 6% growth. Still, the labor market not showing any signs of weakening, at least when it comes to federal employment tax receipts. But you could also argue that this is more of a barometer for employee compensation than it is for the labor market in aggregate. So take it with a grain of salt. Mixed signals in the labor market right now. We'll see how the market determines it. When we look at data next week, because tomorrow the market isn't open, guys, we get the FOMC on Wednesday at 1 p.m. And that's pretty much it. Initial jobless claims on Thursday, the monthly budget statement on Friday, a very lackluster week of data next week, as well as earnings. There's virtually nothing of note. I've looked through all of these, nothing that's going to really move the market. I believe this is the last week before we actually go into Q2 earnings season. Guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.